Ladies and gentlemen, Asian guy here, I need you to stop what you're doing and listen to me very carefully because what I'm about to tell you changes everything. The United States Mint just went dark. They didn't announce it with fanfare. They didn't hold a press conference. They just quietly stopped. No more silver eagles. No more silver bars. The buy button has been disconnected. And that's not even the scary part. The scary part is what this tells us about what's happening behind the scenes. Because mints don't just stop selling. They don't just turn off the printing press in the middle of the biggest precious metals rally in decades, unless something fundamental is broken. Let me paint you the picture of what we're looking at here. The US Mint produces roughly 40 to 50 million silver eagles per year. That's their bread and butter. That's the product that keeps the retail silver market liquid. When Main Street wants to buy silver, they buy eagles. When coin dealers need inventory, they order from the Mint. It's the foundation of the entire American physical silver ecosystem. But yesterday morning, that foundation cracked. The Mint issued a statement buried on page 7 of a Treasury Department bulletin that they are suspending all silver eagle production indefinitely due to supply constraints. Supply constraints. Let that phrase sink in for a moment. The United States of America, the country that supposedly has the deepest commodity markets in the world, cannot source enough silver to mint coins. Now think about the timing. We're not in a recession. We're not in a credit crisis. We're supposedly in a period of economic strength. So why would the Mint run out of silver unless the demand has completely overwhelmed the system? Here's what they're not telling you. The Mint doesn't just buy silver from the spot market. They have long-term supply contracts with refineries. They have strategic relationships with mining companies. They have stockpiles. They have backup plans. For them to halt production means every single one of those safety nets has failed simultaneously. That doesn't happen by accident. Someone knew this was coming. Someone prepared for it. And someone is betting that the panic we're about to see will drive prices through levels that most people can't even imagine right now. But the US Mint going dark is just the beginning, because across the Atlantic, we're getting signals that London is next. The London Bullion Market Association, the entity that sets the global benchmark for precious metals trading, has been unusually quiet lately. Their usual weekly inventory reports have been delayed. Their market makers have been requesting extended settlement periods. And most tellingly, the premium for physical delivery in London has spiked to levels we haven't seen since the banking crisis. Here's what that means in simple terms. When you trade silver on paper, the transaction happens instantly. When you demand physical silver, you have to wait. And the longer you wait, the higher the premium goes. Right now, if you want a 1,000-ounce bar delivered to your vault in London, you're paying 12% over the spot price. 12%. That's not a premium, that's panic pricing. The professionals, the institutional buyers, the sovereign wealth funds, they're all seeing the same data we are. They know that the US production just went offline. They know that retail demand has exploded. And they're doing exactly what you would expect them to do. They're hoarding. But here's where it gets interesting. The same week the US Mint goes dark, we see massive unusual activity in the Shanghai Gold Exchange. Chinese industrial buyers are placing orders for silver that dwarf anything we've seen in recent memory. Not speculative orders. Industrial orders, orders for manufacturing, for solar panels, for electric vehicle components. They know something. They know that the Western supply chain is about to snap, and they're securing their strategic reserves before the rest of the world wakes up to what's happening. And what's happening is a supply shock that has been building for months, but is just now becoming visible to the public. Let me explain the math. Global silver mining production is roughly 850 million ounces per year. That sounds like a lot until you realize that industrial demand alone consumes over 600 million ounces annually. Solar panels, electronics, medical devices, automotive components. Silver isn't just a store of value anymore. It's a critical industrial input that modern technology cannot function without. Investment demand, the coins and bars that people buy to protect their wealth, typically consumes another 200 to 300 million ounces per year. So we're already running a deficit. We're already consuming more silver than we produce. The only reason the market has stayed liquid is because of above-ground stocks, recycling, and government reserves being quietly liquidated. But those buffers are exhausted. The U.S. strategic silver stockpile was sold off decades ago. The commercial inventories held by the big banks have been depleted by years of strong investment demand. And recycling can only provide so much metal when the scrap silver is increasingly being hoarded rather than sold. So when the U.S. Mint goes offline, it's not just removing 40 to 50 million ounces of annual supply from the retail market. It's signaling to the world that the entire supply management system has reached its breaking point, and the market is starting to notice. Silver prices have moved up steadily over the past month, but the real action is happening in the physical premiums. Coin dealers are reporting wait times of 6 to 8 weeks for popular products. Some are simply refusing to take orders because they don't know when they'll get inventory. The spot price might say $28, but try to buy a silver eagle at $28. You can't. The real price, the street price, is already $35 to $40. That gap, that disconnect between paper and physical, is the crack in the foundation that's about to become a chasm. Because once London follows the US example, once the Royal Mint announces their own supply constraints, the message to the global market becomes unmistakable. The age of abundant, cheap silver is over. Think about what happens next. If the two largest English-speaking precious metals markets both admit they can't source enough silver to meet demand, what does that do to confidence in the smaller markets? What does that do to industrial buyers who need silver to keep their factories running? They panic. They overbuy. They stockpile 6 months or a year of inventory just to make sure they don't get caught short. And that panic buying creates the very shortage they were trying to protect against. It's a self-fulfilling prophecy. The fear of shortage creates the shortage. But here's the part that should terrify anyone who understands how global supply chains work. Silver isn't like oil or wheat or copper. You can't just turn on new production quickly. Silver mining is mostly a byproduct of lead and zinc mining. You can't just decide to mine more silver tomorrow. It takes years to develop new mines, and the high-grade deposits have largely been exhausted. So if we're in a structural deficit now, if demand permanently exceeds supply, then price has to do all the heavy lifting. Price has to rise high enough to either destroy demand or incentivize recycling at levels we've never seen before. The question isn't whether silver prices are going higher. The question is how much higher and how quickly. The US Mint going dark suggests we're about to find out. And if London follows, if the global supply network starts breaking down in real time, then we're not just looking at higher prices. We're looking at a complete repricing of silver as an asset class, from a monetary curiosity to a critical strategic resource that nations and corporations will fight to control. But let me tell you what's really happening behind the scenes, what they don't want you to understand. Because this isn't just about supply and demand anymore. This is about control. 3 weeks ago, before any of this became public, we started seeing unusual movement in the COMEX warehouses, massive withdrawals, not the usual ebb and flow of trading inventory, but systematic drainage. Someone was taking delivery of physical silver in quantities that would normally take months to accumulate. The registered silver, the metal that's available for immediate delivery, has dropped to levels we haven't seen since the Hunt brothers tried to corner the market in 1980. But this isn't retail speculators. This isn't even hedge funds. The delivery notices we're seeing have industrial shipping addresses, warehouses in Texas, distribution centers in California. These are companies that make things, companies that need silver to keep their production lines running, and they're scared. Tesla alone uses roughly 2 million ounces of silver per year for their vehicles. Apple consumes even more for their electronics. When companies like that start taking physical delivery instead of relying on just-in-time supply chains, it tells you they've seen internal projections that haven't made it to the public yet. They know what's coming in the fourth quarter. They know about the solar panel manufacturing surge that's been planned across multiple continents. They know about the electric vehicle production targets that require silver at levels we've never seen before in human history. But here's where it gets darker. Here's where the real manipulation becomes visible. The big banks, the ones that have been managing the silver market for decades, they've been caught completely off guard by this demand surge. For years, they've been comfortable selling paper contracts, knowing that most would settle in cash rather than physical delivery. It was easy money. Sell infinite paper silver into a market that rarely asked for the real thing. But something changed in the past 6 months. The delivery requests started climbing, first gradually, then exponentially. By August, the ratio of paper to physical settlement requests had inverted completely. Everyone wanted the metal. And that's when the banks realized they had a problem, a big problem. They don't have the silver. They've been selling contracts backed by nothing more than accounting entries and the assumption that demand would never exceed their ability to source metal from the spot market. But the spot market is disappearing. Look at what happened in Europe last month. 3 major precious metals dealers in Germany announced extended delivery delays, not temporary supply hiccups, permanent restructuring of their business models, because they can no longer guarantee physical delivery within reasonable timeframes. Switzerland, the country that processes more precious metals than anywhere else on Earth, has seen its refineries operating at maximum capacity for 18 consecutive weeks. Their waiting lists for silver processing have stretched from days to months, and still, industrial buyers keep placing orders at premium prices. This is what a supply crisis looks like in real time. Not theoretical shortages based on mining projections, but actual operational failure of the distribution network. The US Mint going dark wasn't a policy decision. It was a surrender. They looked at their remaining inventory, calculated their forward commitments, and realized they couldn't fulfill both. So they chose to preserve what little silver they have left for essential government purposes. But what are those essential purposes? What does the government need silver for that's more important than maintaining public access to constitutional money? Defense contracts, military applications, strategic reserve requirements that they haven't disclosed to the public. Because silver isn't just about electronics and solar panels. It's about missile guidance systems. It's about advanced radar technology. It's about the components that keep military satellites functioning in space. When the Pentagon calculates its critical materials requirements, silver is near the top of the list. And right now, with geopolitical tensions escalating globally, military demand for silver is consuming inventory at rates that dwarf civilian industrial usage. But they're not telling you this. They're letting you believe this is just a market imbalance that will correct itself when new mining production comes online. New mining production that doesn't exist. Here's the reality that the mining industry doesn't want to publicize. Silver grades in existing mines have been declining for over a decade. The easy, high-grade deposits were exhausted years ago. Today's mines are processing ore that contains half the silver concentration of mines that were operating 20 years ago. Meanwhile, the cost of extraction has more than doubled due to energy prices, environmental regulations, and the simple reality that you have to dig deeper and process more rock to get the same amount of metal. New mine development, even if it started tomorrow, takes 7 to 10 years to reach full production. And most new silver discoveries are in jurisdictions that present significant political risks, countries where nationalization is a constant threat, countries where mining operations can be shut down overnight by government decree. The secure, reliable sources of silver production are depleting faster than they can be replaced. So when I tell you that the US Mint going dark is the beginning, not the end, of this crisis, I'm not being dramatic. I'm reading the data that most people either don't have access to or don't understand how to interpret. London is next, because London is seeing the same inventory drains, the same delivery pressures, the same industrial panic buying that forced the US Mint offline. The Royal Mint has been quietly extending delivery timelines for months. Their suppliers have been requesting extended payment terms. Their wholesale customers have been placing orders at sizes that exceed historical norms by factors of 5 or 10. When London makes their announcement, and they will make their announcement, the signal to the global market will be unmistakable. The two largest English-speaking precious metals markets cannot source enough silver to meet demand. That announcement will trigger buying panic in every other market. Asian buyers will rush to secure inventory before regional mints follow the same path. European industrial users will abandon just-in-time purchasing and build strategic stockpiles. Retail investors will realize that their window to acquire physical silver at reasonable prices is closing rapidly. And price? Price will do what it always does when demand far exceeds supply and new supply cannot be created quickly. It will rise until equilibrium is restored. But in this case, equilibrium might mean silver prices that seem impossible from today's perspective. Because we're not just dealing with investment demand or industrial demand in isolation, we're dealing with supply chain panic, fear-based buying. The realization that silver is not just valuable, it's irreplaceable for the technologies that define modern civilization. The shortage has begun. The institutions know it. The governments know it. The question is whether you understand what this means for everything else in your financial life. Because once the mints start closing, once the dealers run out of inventory, once the industrial users start hoarding, the window to position yourself closes very quickly. And when it closes, it might not open again at prices that ordinary people can afford. The US Mint didn't just halt silver sales. They fired the starting gun on the greatest precious metal squeeze of our lifetimes. But there's something else happening. Something that makes this entire situation exponentially more dangerous than what we saw in the 1970s, or even during the 2008 financial crisis. The derivative market has exploded. Most people don't understand this, but the silver futures market trades roughly 300 times more silver on paper than actually exists in deliverable form. 300 times. For every ounce of real silver that can be physically delivered, there are 300 paper claims on that same ounce. In a normal market, this works fine because most traders never ask for delivery. They trade for profit, not for metal. But what happens when that changes? What happens when suddenly everyone wants the real thing? We're about to find out. The total open interest in COMEX silver futures represents roughly 2 billion ounces of silver. The entire above-ground inventory of silver that's ever been mined in human history is estimated at around 50 billion ounces. But here's the critical number. The amount that's actually available for industrial and investment use, the amount that's not locked up in jewelry or buried in landfills or lost forever, is probably closer to 15 billion ounces. And of that 15 billion, maybe 2 billion, is in forms that can be quickly mobilized for delivery against futures contracts. Do you see the math problem? The paper market is making promises it cannot possibly keep. For decades, this didn't matter because the system was built on confidence. confidence that most traders would settle in cash, confidence that industrial users would continue buying from traditional supply channels, confidence that retail investors would be satisfied with ETF shares instead of demanding physical metal. That confidence is evaporating in real time. And when confidence disappears in a fractional reserve system, you get what economists politely call a bank run, but what really amounts to systemic collapse. We're seeing the early signs everywhere, not just the US Mint going dark, but subtler indicators that most people aren't trained to recognize. 3 major silver ETFs have quietly changed their redemption terms in the past 60 days. Extended notice periods, higher minimum redemption amounts, additional fees for physical delivery. These aren't random policy updates. These are desperate measures by fund managers who are watching their inventories drain faster than they can be replaced. The largest silver ETF, SLV, holds roughly 650 million ounces of silver on behalf of shareholders. That sounds massive until you realize that industrial demand alone consumes that much silver every 10 months. If even a small percentage of SLV shareholders decided they wanted physical silver instead of paper shares, the fund would be in immediate crisis. And guess what's happening to ETF redemption requests? They're surging, not just from retail investors, but from institutional holders who are starting to question whether their paper claims will be honored when the music stops. Meanwhile, we're getting reports from precious metals dealers across the country that their wholesale suppliers are implementing allocation systems. Not higher prices, not longer delivery times, actual rationing. You can only buy so much silver per month, regardless of how much you're willing to pay. That's not how free markets are supposed to work. That's how command economies work. That's what happens when the price mechanism breaks down completely and quantity restrictions replace price discovery. But here's where it gets really interesting, where we start to see the geopolitical chess game that's been playing out behind the scenes. China has been remarkably quiet about their silver imports this year. Usually Chinese trade data is reported monthly with great fanfare, but silver import numbers have been delayed, revised, and in some cases simply not reported at all. That's not bureaucratic inefficiency, that's strategic opacity. Because while the Western markets have been focused on paper trading and financial engineering, China has been quietly building the largest strategic silver reserve in human history. Not through flashy government announcements or public stockpiling programs, but through private industrial purchases that fly under the radar of international monitoring systems. Every solar panel factory they build requires silver. Every electric vehicle production line needs silver. Every 5G infrastructure project consumes silver. And they're building all of these simultaneously at scales that dwarf anything ever attempted in human history. The West has been treating silver like a financial asset, something to trade for profit. China has been treating silver like a strategic resource, something to accumulate for industrial dominance. And now, just as Western supplies are running critically low, China is positioned to control global pricing through simple supply and demand mechanics. They don't need to manipulate markets. They don't need to engage in currency wars. They just need to keep buying silver at current prices while Western mints shut down and Western dealers implement rationing systems. Market control through resource scarcity. It's the oldest geopolitical strategy in the world, and it's happening right now in real time. But there's an even deeper layer to this story, one that connects the dots between the US Mint shutdown, the brewing crisis in London, and the broader transformation of the global monetary system. Central banks around the world have been quietly accumulating precious metals for over a decade. Not just gold, silver too. But they don't report their silver holdings the way they report gold reserves. Silver purchases get buried in other assets categories or classified under strategic materials acquisitions. Why the secrecy? Because silver serves dual purposes that gold doesn't. It's both a monetary metal and a critical industrial input. Central banks can accumulate silver for monetary reserves, while simultaneously securing strategic materials for domestic industries. It's the perfect stealth accumulation strategy. And now, as the physical supply crisis becomes undeniable, these same central banks are positioned to benefit from both the monetary and industrial value increases. Think about the timing. The US strategic silver stockpile was sold off in the early 2000s. European central banks have been tight-lipped about their precious metals policies. Meanwhile, countries like Russia, China, and India have been expanding their strategic materials reserves across multiple categories. Western governments gave up control of silver supplies, just as Eastern governments were securing them. That's not coincidence, that's preparation. The US Mint going dark isn't just a supply problem, it's a national security problem. Because silver isn't just about coins and bars anymore, it's about maintaining technological competitiveness in a world where the countries that control critical materials control the future. Military satellites require silver, advanced radar systems require silver, missile guidance systems require silver, electronic warfare capabilities require silver. When the Pentagon realizes that domestic silver supplies are insufficient to meet both civilian and military needs, what do you think takes priority? The civilian market gets rationed first. Industrial users get restricted access. Retail investors find themselves locked out entirely. And prices? Prices become irrelevant when quantity restrictions replace market mechanisms. We're not just watching a precious metal squeeze, we're watching the weaponization of resource scarcity. London is next because London is facing the same impossible mathematics, the same derivative overhang, the same industrial demand surge, the same geopolitical pressure, then Zurich, then Perth, then every mint and dealer and ETF that has made promises they cannot keep. The dominoes are falling, the system is breaking, and the countries and institutions that prepared for this moment are about to reshape global power structures through simple supply control. And here's what you need to understand about timing. This isn't a gradual process that unfolds over months or years. Resource shortage crises accelerate exponentially once they reach critical mass. Look at what happened in the lithium market between 2021 and 2022. Prices were stable for years, then doubled in 6 months, then doubled again in 3 months. Not because demand suddenly appeared overnight, but because the tipping point between adequate supply and shortage is razor thin. Silver is approaching that same tipping point right now. The US Mint shutdown was the canary in the coal mine, but the real signal, the one that tells us we've crossed the point of no return, will be when major industrial users start bidding against each other for available supply. And that's already happening. Tesla recently placed an order for silver that was 3 times their normal quarterly requirements. Apple has been securing 6-month forward contracts at premium prices. Samsung has been building strategic inventory at levels that suggest they're preparing for extended supply disruptions. These aren't speculative purchases. These are survival purchases. Companies that rely on silver to manufacture their products are prioritizing supply security over cost optimization. When corporate treasurers at trillion-dollar companies start panic buying raw materials, you know the situation has moved beyond normal market dynamics. The shortage isn't just beginning, it's accelerating. And after that, the real panic begins.